Investors and traders, welcome to the channel. Today is 28th of July 2024. Hope everyone is having a great weekend. In this video, we will be talking about the great rotation, which in my opinion is taking place in the US stocks. We have seen a fair amount of volatility come in over the past couple of weeks. And here at Market Chart Pattern, we have actually been pretty lucky to be able to identify certain key patterns, which actually call some exact price points and levels, which you can go and check back in the archives. And what we have seen also is over the past couple of weeks is that we have seen certain indices such as growth stocks and also SP500 moving lower, but some of the other indices such as Dow Jones, which is a price weighted index, and also the small caps, in particular Russell 2000, actually performing much better. So this is what we'll be discussing, and towards the end of the video we'll actually dive into the technicals of the markets, and I will also give the standard deviation levels for the expected ranges for next week. As always, this video is for educational purposes only and it is not a financial advice. Alright, so we'll start by taking a look at the chart, which we have actually taken a look at previously as well on the channel. So this is the quarterly chart for the SOX, which is the semiconductors index ratio to the gold bucks index ratio. So basically you take the semiconductors price and you divide it by the gold bucks index, which is an index of gold miner stocks, and you plot the chart and you see something really interesting. So what we have seen is a peak coming in this ratio in July 2000, and back then we had the internet and the dot-com era, and also the Fed fund rates were above 5%. And now quite recently, actually beginning of this year, we have seen a move which is kind of similar to what happened back in 2000, and it has reached pretty much the same levels, but the ratio hasn't exceeded that on closing basis yet. And what we have going on now is we have the blockchain and the artificial era, and the Fed fund rates are also greater than 5%. Now, I'm not here calling in a dot-com bust kind of scenario here. I'm just trying to paint a picture that what we are seeing now is actually perhaps a possibility, in my opinion, of what is going on is a rotation in the marketplace, where the tech stocks, they have been a hot place to be in for quite a long time, and there have been other sectors and other kind of stocks, especially in gold mining and base metal mining stocks, which have been kind of unloved for quite a long time. And this is what this chart is telling us. If you look at this chart on the left hand side, when it peaked around here, this is the time when the investors actually started to move out of the semiconductor stocks, which are really basic building blocks for a lot of things, because they include chips, so it's hardware, it's computers, internet related. And while that back then the dot-com bubble was bursting, there was actually a movement of money going into, which at that time was quite unloved sector, gold mining stocks. And in fact, around 2001 and 2002, gold itself started a bull run and is still going on. So the underlying commodity is much higher now compared to when it was back then around 2000, roughly speaking, from the memory. Now, this really interesting point around here is again in 2011, and what we can see is that the gold mining stocks, they actually performed they performed pretty well for the next maybe couple of years, and then it just goes sideways for a very long time. And then it's 2011 is when the gold, the underlying commodity, actually peaked by making a new all-time high. And this is where we see the gold miners just not perform well at all, and the money starts to move back into the semiconductors, which had been a growth area. And then where we are now is actually something really interesting happening. In my opinion, if there is going to be a rotation, more money moving out of semiconductors or even the growth stocks, such as Nasdaq 100 stocks, then this really unloved area could actually benefit from it, and this is what this chart is all about. So some of these mining companies, gold miners, some of them are profitable as well, but their prices are really depressed, so great value to be found in those. But one has to be really selective and careful when looking at the gold miners. There are two broader classes. There are actually royalty stocks, and then there are miners. So miners will have a different kind of a cost structure because they're actually involved in the process of mining and exploring the underlying commodity, whereas the royalty stock do not get involved into that operational side of things. They're actually collecting royalty, and you'll typically find these royalty stocks much higher in price compared to what we will see for a gold miner, for example. So now we'll just move to the next chart. Here we go. So this chart is actually a Nasdaq 100 to semiconductors index ratio. So it's really interesting to look at this one because Nasdaq 100, as you know, is the technology stocks. These are high growth stocks, and SOX is more semiconductors, all the chip makers. And what we see, something really interesting, is that our ABCD pattern, that one-to-one price projection that we really like to take a look at on this channel. They're also really operational on these ratios as well, and in fact they are telling us a story. So what we look at is here, it's like and since 1995 to 1998, the Nasdaq stocks were performing pretty well to the semiconductor stocks. And then we get into a point where we have this pattern as well, but the semiconductor stocks, they begin to do much better, and we can see that there's actually a decline right into the 15th of April 2002, and that's when actually the growth stocks, which may or may not be the semiconductor stocks themselves, largely not semiconductor stocks, they actually start a bull run which goes right up to the 2012, and then here it completes this big ABCD pattern, price pattern, pretty much around this key 1.272 Fibonacci expansion as well. I'm not going to go into too much technicals into for this chart, but we had a confluence of two things coming around here, and that also happens to mark a top on this market. So thus far what it is telling us is that it looks like there is a cycle to these things, and the semiconductor stocks, which are primarily making chips, they are kind of the construction material which is used to build a house, for example, and then once you have built a house, someone can come in and live in that house for a much longer period, and it could be sold on to other parties as well. So this is how, in a simplistic way, I'm looking at it, and this is why I think there is a cycle to it, that semiconductor stocks, they actually begin to outperform when there is actually a underlying technology which is powering a lot of hardware, for example. So for example, current example will be NVIDIA's chips, which are being used to power this artificial intelligence revolution that is taking place. And then another cycle starts after that, there is enough of these or there is already a lot of development which has taken place in terms of having revolutionary chips being available. Now the second phase actually involves in the usage of it and building things on top of it, where different companies can come in and begin to make use of these products available to them, these chips available to them, and then we begin to see a different kind of a cycle in which, in fact, the other non-semiconductor companies, still growth companies, could actually begin to outperform. So it appears to me that we are actually here at a pivotal point, and we might have already reached that or getting very close to it. And the reason is that you see this red ABCD pattern is just completing right around this 3.45 ratio, roughly speaking, which also happens to be a key Fibonacci support level around here. So if this pattern, as I'm thinking, is already completed or likely to complete, what we are going to see is perhaps a rotation out of semiconductor stocks or semiconductor related stocks, and moving back into some other companies who are actually making use of this technology. So this will be an interesting place to be and to see actually this kind of rotation happen. And over the past 18 months or so, we have seen certain stocks which are semiconductor related chip makers do extremely well, and it's possible that actually they will still be leader in their fields, but there could be a rotation out of those, and there could be other companies which actually might not be doing as well right now, but they will also begin to take a lead as we begin this rotation. All right, so we'll take a look at the next chart. So this chart is basically a ratio of Nasdaq 100 to the Russell 2000. So Nasdaq being the growth stocks and Russell 2000 being the small caps. And if we just look at the chart on the left hand side, we have a peak coming. This is a 1 month chart, so it's monthly chart in March of 2000. And what we find interesting is that now, based on history, we know that the dot-com bubble was starting around that time. The tech stocks were really under pressure, so we saw some rotation, money moving out of the tech stocks and perhaps moving into smaller caps, or the smaller caps actually begin to outperform. And one of the key things was that, of course, there was another rally attempt here, and then when this low was taken out, boom, there was a lot of downward pressure, or the small caps actually began to outperform in earnest. Now, fast forward many years, and what do we have here in around the year 2000? We see a similar kind of situation, but again, here it put in a bottom, and then again, it's a V bottom around here where the Nasdaq begin to outperform the small caps, and then there is actually a higher bottom here. And then where we are now, we are seeing a quite a sharp move in this ratio, and we begin to see that the small caps are again outperforming the growth stocks. So obviously this means that there is a rotation. Some money is moving out of the growth stock. It's going, some of it is perhaps going into the small caps, because small caps have been doing pretty well pretty recently, last couple of weeks. It might be going elsewhere as well. And the other interesting thing is actually, how do we make use of this? So we have seen this kind of situation around here as well, but at no point this previous high in this ratio was taken out until fairly recently. That's one point. And the other point to note is that for this to become a trend, we really need to see certain key points on the chart being broken. So for example, when we have this move down here, we did not actually break down this low. We had a higher low, which eventually led to a higher high. So if it needs to become a trend, it needs to be some situation like this, where we begin to see on consistent basis certain key lows being taken out. So we get a trend or a change in trend, where we have a sequence of lower lows and lower highs. But only in time we'll find that out, because a number of things or support structures need to be disrupted before that happens. But here it's really interesting to see that why we see some of this volatility come in the high growth stocks. One of the reasons could possibly be a rotation taking place, and some of the money actually moving into smaller caps. So let's take a look at the next chart. Now this one is a pretty interesting chart. This is the ratio of Nasdaq 100 to the 2-year Treasury note. As you know that the US Treasury note, it's at least theoretically considered to be a risk-free investment, and with the interest rates being higher over the course of last couple of years, it is actually offering some yield as well. So here it becomes really a question when we look at this chart, because here we have certain turning points. For example, we had a turning point come in here. This was around the September of 2018, so this is a few years before the pandemic. And also it made a double top around here as well. But then actually what we began to see was a sharp move lower, where the money was really moving out of the tech stock and moving into the treasury notes. This happens to be the 2-year treasury note, but it could also be moving across the yield curve, so basically into the treasury. So here it becomes a question that needs to be asked, especially around these turning points, that if we have a choice between stocks and bonds, where my money is likely to be more safe, or where my money is likely to be growing, or where I'm actually be able to get the return of my money, not just the return on money. So these are the kind of situations where, in my opinion, these turning points, the investors might be actually asking themselves this question, because a long time ago, this is something Warren Buffett actually spoke about as well. He actually mentions that over a longer period of time, the stocks are going to outperform the bonds. Because going back several decades, 1930s, 40s maybe, there was a perception that actually bonds outperform stocks, which is actually not the case. I'm not going to go into the details of that, but actually it might have to do something with the mindset around that time, which existed due to the 1929 crash of the stock market. It's another topic to be discussed. But at least in bonds, you are able to get your money back, and then coupon on top. If it's paying a pretty decent coupon, you can actually make a decent return. So here what is key to note is that these turns have come in at really key dates, especially around here. You can see in 2018 a decline right into December, then a V bottom around here. I believe this is where the Federal Reserve was actually coming in, and Jay Powell, the Fed chairman, he was quite new in his job, and he made a comment about quantitative easing being on a autopilot or something like that, based on my memory, and the market actually began a sell-off, and quite a lot of that money actually began to go into the treasuries. And here the position reversed, and we began to see the Nasdaq 100 begin to outperform the 2-year treasury note, which was a great signal. And we have seen something similar happen around here. This is when the pandemic actually began to start, so around February of 2020. A lot of panic coming into the market, and again we saw a in month of March, perhaps later March, a V bottom form, and then where we are now. Let's discuss where we are now here. So we have completed this big ABCD pattern here, which is 1-to-1 price projection. AB swing is equal to the CD swing. So this is a line chart, but I think in price chart formation, we are actually pretty close to this level. So what is going on is actually really interesting. And if we just look at on the left hand side, just the recent data, this is when we were in July 2023. And here we have this signal again, where the 2-year treasury note began to outperform the Nasdaq 100, and it led to a correction which ended in October 2023. It's even more interesting that here, back in November of 2021, the Nasdaq 100, the 2-year treasury note began to outperform the Nasdaq 100, and it led to a bear market which ended in October of 2022. So really interesting where we are right now, because what we are seeing is a sharp pullback in the Nasdaq 100, and the 2-year treasury note, its yield is moving lower, price is moving higher. So actually we are seeing a sharp decline around here as well. Whether we get a V bottom again and it begins to move up, this is something which we'll be watching really carefully. But as the theme is that perhaps there is some rotation happening, where some of the money moving out of these high growth stocks is also moving into the treasury note markets, and a really important level that we need to watch is this 170-150 level, because that's an important low. Moving below this will change quite a few things. It's quite a while should it get there. Now let's move to the next chart, and this chart is a pretty interesting chart because this is the Nasdaq 100 ratio to Raytheon, which is a defense stock. So perhaps once in 50 years, half a century to quarter of a century, there comes a time when the defense related stocks, they begin to outperform some of the high growth stocks as well. So I'm not entirely sure what might have been the situation around here, but we have seen in the year 2000, that's when the dot-com bubble actually popped up. This stock, if someone had owned this stock, they would have done much better than the Nasdaq 100 index growth stocks themselves. And what is pretty interesting is that where we are right now here, we are right at the 61.8% retracement, which could be a interesting level to watch. There is potential for a double top here. It's just an interesting concept to keep on watching, that perhaps there comes a time when one needs to look at some of these defense sector related stocks, because they might actually begin to provide a much better place for money to be parked into. All right, so we'll now begin to move into the market technicals. And here we start with our timing chart. So we had a timing coming in last Friday, and interestingly, we had seen a pretty good rebound in the markets, especially a really good rebound in the Dow Jones Industrials, and also in the Russell 2000 index as well, and the Nasdaq 100, the growth stocks, and the SP 500, they did better as well, and they closed positive for the day. So that is really interesting. Now, per our timing model, we have a next date coming up tomorrow, so 29th of July. It'll be interesting to see how the market is going to perform. Interesting part to note is that markets found support right at the 38.2% retracement. So as long as the market actually stays above that, it is likely to move higher. Now we have a really key date, the bigger date coming between 29th of August to 3rd of September. That is something that window will be paying really close attention to when we get there. Again, with the timing, we have to give it 2 to 3 trading days on either side. So again, time will tell us what the market has in store for us. And then moving on to the next chart, this is the big ABCD, which completed in the Nasdaq futures chart. This is a continuous contract. So ever since it hit this 20,750, which was the level we had forecasted months in advance, we have seen sharp decline in the market. The market has moved lower by about 10%. And the really key level that we had been watching for closing basis on the weekly chart in particular has been this 18,770 level. So we came close to it, but it found support and bounced back. The 61.8% retracement is around 18,580, slightly below that, but the market have seemed to have found support from the 20-week moving average. And look at this trend line around here. It's got a pretty steep slope, but support level here, and then of course we have the second one. So there's plenty of support around here should the market begins to probe these areas, but there's actually a possibility which I'll show you on this chart. Here we go. On the daily chart, look, the market corrected about 10% thus far, which is bigger than what happened in March and April. So the interesting thing is, since the beginning of the year, sorry, I lost my train of thoughts. So it has been one of the bigger corrections thus far. And what is really interesting for this one is that actually we have this ABCD one-to-one price projection completing nearby, and also last week the market came between the -1 and -2 standard deviation levels. So those are the kind of expected ranges. So the market was orderly. Now, if we look at the daily chart of the S&P 500, we have corrected about 4.85%, and the correction in March to April was about 6%, 5.93. So This one is giving a different kind of a pattern formation. It's stronger than the Nasdaq 100, and it also completed this ABCD right at the minus one standard deviation level last Thursday on the futures chart. This one is the cash chart. There is still a possibility maybe it can go and keep this fill this gap incomplete, but it's also possible that this gap actually left open, in which the price then begins to move higher. And also we have this support line, this trend line coming around here. So there is a confluence of plenty of things coming around here, suggestive that actually the market is looking to find a good support and start to move, in fact, higher. So interesting junctures. Now this is the weekly chart of the S&P 500 cash market. One thing I want to point out is the blue line is the long-term trend line, as it's intact. Look at where the price is. So much air in between this trend line and where the market closed last week. Now the Nasdaq completed our big ABCD pattern, but the S&P 500 did not. And this big one completes for us around here, 6,110 level. So our perspective is that market is still likely to move higher. The S&P 500 in particular, the Nasdaq 100 may actually go sideways for quite a while. At least we have this bullish scenario till October, November of 2024, that the market is actually likely to move higher, and this is the target that we are actually looking for, that the market could actually achieve based on this pattern. Now should we begin to actually start a different kind of a cycle in which some of these really important lows begin to be get taken out to the downside, we'll have to reevaluate things. But here we still have the bullish scenario for the market to move higher, complete these patterns, and come in line with the pattern completion with respect to the Nasdaq 100. So here, interesting thing happened last Thursday. Market came right at the 38.2% retracement on futures, minus one standard deviation level. We have the ABCD there. We saw a bounce, and the chances are that the bounces could actually be sustained in next week. This is the daily chart of S&P 500 futures, E-mini futures. And here it found support from the 38.2% retracement. Look what a nice looking day it had on last Friday. This ties back with the concept of the rotation that we have been talking about. So it was nice to see such a good price bar last Friday. Here, this is the weekly chart of the Dow Jones E-mini futures. Now, after reaching this 41,600 level, the market actually retraced a little bit because it had completed this bigger or an extension of the ABCD pattern. But the chances are that this market also wants to complete the bigger ABCD, which is in black. So we have actually higher price targets as well, which is pretty interesting. And look, there has been this channel as well, and market is right at the top end of this channel, so some sort of sideways action to a little bit lower could be expected. But again, the chances are that actually this market also wants to complete this bigger cycle ABCD, and go higher from where it is. At least the time frame we have been looking at is till October, November 2024. Now this is the weekly chart of the Russell 2000, and you can see over the course of last 3 weeks, Russell has really outperformed the growth stocks here, and this is what we looked at in the ratio as well. So it's moving right into this zone that we had identified. It'll be really interesting to see how the market will perform when it's already moved into this box, whether it's able to actually complete this ABCD pattern and actually aim for 24,000. We'll have to wait and see. Now let's also take a look at some of the European markets. So this is the FTSE 100. This is the 100 leading stocks in the United Kingdom. And last Friday, the market closed really, really positive. Like there's a lot of strength in this market. it tested this support around here, 81,117, for a number of days. You can see the market was just sideways, and now it looks like a rocket ship kind of a move. Again, I will see what will happen next week, but the chances are, if this move is sustained, it's likely aiming for 86,000. And then in the next chart, we see the German DAX. Now, the German DAX has been sideways ever since it hit the 1.272 expansion at 18,833. And so it's been in a sideways price action since May. So pretty big trading range. But again, you can see that there's a series of higher lows, and this trend line is actually intact. So chances are it might be actually moving towards this 1.61 expansion on 19,160. So this is what is happening in some of the foreign markets that we like to follow. And then finally, what I have here are the weekly ranges to be expected per their standard deviation levels for the future indices futures that we like to follow. So that's the S&P 500 E-mini futures, Nasdaq 100 E-mini futures, Dow Jones E-mini futures, and Russell 2000 E-mini futures. And here what you see is the VIX closes, the weekly closes as of last Friday. And for the Nasdaq 100, I am using the VXN, and for the Russell 2000, I am using the RXN, and for the S&P 500 and Dow Jones is the VIX index that I'm using to compute these levels. So I think you will find these levels pretty useful. Thank you very much for watching the video, and if you found this video of educational value, you found it helpful, educational, then please do subscribe to the channel as well. And if you do, then hit that bell icon button. That way you will know when the new videos are posted. If you found this video nice, then give it a thumbs up. I will really appreciate that. Again, thank you very much for watching the video. Good luck, good trading, and speak to you guys soon.